You're working hard, growing your business, you're hitting all your revenue milestones. Come tax season, you're left wondering, where did all my money go? Well, if you've ever felt that way, you're not alone. Far too many business owners overpay in their taxes every single year, not because they did anything wrong, but because no one ever showed them how to play offense. And no, we're not talking about risky loopholes or pushing the gray areas of the law. What I'm talking about is completely legal, IRS compliant tax strategies that smart business owners use every single year. The ones that the wealthy almost always implement, and most small business owners never really hear about. So let's fix that today. Hello, I'm Scott Norris. I'm an investment advisor with Royal Fund Management, and I help entrepreneurs, professionals, and business owners just like yourself build smart, tax-efficient, value-driven financial plans so you can stop bleeding money unnecessarily and start putting more of your hard-earned income to work. In this video, I'm going to walk you through 5 foundational legal tax strategies every business owner should understand. These are real strategies, not vague tips. Ones that could save you thousands of dollars this year and even more over time if implemented the right way. So let's get into it. Number 1, choosing the right business structure. If you're still operating as a sole proprietor or a basic LLC, there's a good chance you're paying more in taxes than necessary, and no one's ever told you otherwise. It's one of the most common mistakes that I see with business owners who do well but haven't made the shift to be a more optimized structure. On paper, everything looks fine. The revenue's coming in, the expenses are tracked, and the business is profitable. But behind the scenes, you could be losing thousands each year in avoidable self-employment taxes. Here's why. When you're a sole proprietor or a single member LLC without any special tax election, you're usually required to pay self-employment tax on 100% of the business's net income. That's currently 15.3% for Social Security and Medicare on top of whatever your income taxes you owe. So if your net income is $150,000, you're potentially paying over $22,000 just in self-employment taxes alone before even touching your federal or state income tax. That's where restructuring your business can make a significant impact. Many business owners in this income range benefit from switching to a subchapter S corporation or having their LLC taxed as an S-Corp. This election doesn't change the legal structure of your business, but it changes how your income is taxed. Instead of paying self-employment tax on all of your profits, you pay yourself a reasonable salary, which is subject to payroll taxes. Any additional profit left in the business can then be distributed to you as a dividend, not subject to self-employment tax. So let's break that down. Let's say your business earns $150,000 in net income, and you pay yourself a reasonable salary, say $80,000, which is taxed as regular wages. With payroll taxes, the remaining $70,000 is passed to you as an S-Corp distribution. You still pay income tax on the $70,000, but not the 15.3% self-employment tax. That could save you more than $10,000 per year by just making one strategic change. Now, this isn't a one-size-fits-all decision. The IRS requires that your salary be reasonable, and there are administrative responsibilities that come with being a subchapter S, like running a payroll and filing corporate tax return. But for business owners generating consistent profit over $75,000 to $100,000, this move can be a game changer. What I feel most people don't realize is that this isn't a loophole, it's a planning opportunity. The tax code allows for this structure, and smart business owners take advantage of it. If your business has grown and you haven't reviewed your structure in the past year or so, now may be a great time to look at whether S-Corp election could help you reduce your overall tax liability and keep more of what you earn in your pocket. Number 2, use a retirement plan built for business owners. If you're a business owner and the only retirement account you have is a traditional IRA, you're likely leaving money and tax savings on the table. One of the biggest missed opportunities I see successful entrepreneurs and small business owners is not leveraging the retirement tax tools that are designed specifically for them. So why does this even matter? Well, because retirement accounts don't just help you build long-term wealth, they also tend to give you powerful legal ways to reduce your taxable income today while investing for your future. And the best part, unlike employees at large companies who are limited to do a one-size-fits-all 401k plan. You get to design your own. Here are a few of the most effective options that wealthy business owners use to build long-term wealth and reduce taxes now. A solo 401k, typically best for solo entrepreneurs and owner-only businesses. If you don't have any full-time employees, maybe other than your spouse, the solo 401k can be one of the most flexible and powerful planning tools available. Here's why. You can contribute both as an employee and an employer. In 2025, the total contribution can reach up to $70,000, or if you're above the age of 50, $77,500. You can choose Roth or traditional contribution depending on your tax goals. You have the option to take loans which aren't allowed in IRAs, and this plan is straightforward to set up and maintain, and it gives you a way to shelter tens of thousands of dollars from taxes each year while investing in the market or alternative assets. A SEP IRA, great for high profit businesses with few or no employees. The SEP IRA allows you to contribute up to 25% of your compensation, up to a cap of $70,000 for 2025. The pros, the contributions are tax deductible. It's easy to set up, just a few pages of paperwork. There's no annual filing requirements, but the trade-off is that if you have employees, you're going to be required to make proportional contributions for them as well. So it's best for owner-only businesses or those with a small, highly paid team. A defined benefit plan. This is ideal for high-income earners 50 plus. This is the lesser known but seriously powerful option for business owners who want to maximize deduction and catch up on retirement savings. Here's how it works. It's like a personal pension plan that you fund for yourself. You can contribute up to $280,000 per year depending on your age and income. Contributions are fully tax deductible. You can layer this plan on top of a 401k or SEP IRA. Yes, it requires more paperwork, actuarial calculation, and long-term commitment, but for business owners nearing retirement with strong cash flow, this is one of the most aggressive legal tax shelters available. Retirement for business owners shouldn't be about checking boxes. It should be about building a coordinated, tax-efficient system that matches your income, your stage of business, and your long-term financial goals. The IRS gives you more room to work with you when you own a business, but unless you know the rules or work with someone who does, you may never ever benefit from them. If you're earning six figures or more in business, I believe it's time to take a look beyond traditional plans and start building a retirement strategy that actually works for business owners. Number 3, turn your business expenses into personal tax wins. Let's get one thing straight. I don't recommend that you should spend money just to get a tax deduction. But hey, if you're already spending that money, and that money has a legitimate connection to your business, then you should absolutely be asking yourself whether it is deductible. This is where smart business owners operate differently. They don't just log receipts and move on. They look at every dollar that leaves the business and asks, is this a qualified expense? Can this be structured to benefit both my business and my personal bottom line? The goal is to align your lifestyle with your business activities legally and maximize the benefits that are available to you. Here are some often overlooked deductions that can make a real difference. A home office deduction. If you work from home, even part of the time, you may qualify to deduct a portion of your home expenses. This would include things like your mortgage interest or rent, utilities, internet, insurance, repairs and maintenance. There are 2 methods for this, the simplified method and the actual expenses method. If you qualify, this can reduce both your income tax and self-employment tax. But be careful, this needs to be a dedicated workspace used regularly and exclusively for business. No blending it with your dining room table or a shared playroom. Business use of your vehicle, if you use a vehicle for business, whether for client meetings, deliveries, or work-related errands, you can deduct those as well. The standard mileage rate for 2025 is 70 cents. Or you can use the actual expenses, fuel, maintenance, insurance, and depreciation. The key here is documentation. A mileage log or an app can help you track your usage accurately. Also worth noting addition, purchasing a qualified heavy vehicle over 6,000 pounds can offer substantial bonus depreciation in the year of the purchase if it's used primarily for the business. Pay your children, or if you're married, pay your spouse. If you hire a family member to do legitimate work in your business, such as administrative tasks, marketing, cleaning, or IT support, you can deduct their wages as a business expense. You can shift taxable income into a lower bracket if they are in one, possibly eliminate tax entirely if they earn less than the standard deduction. For example, if you hire your teenage child and pay them $15,000 or less in 2025, that income could potentially be tax-free for them while still reducing your business's taxable profit. Again, this needs to be real work for fair pay. This isn't a loophole. It's a strategy grounded in the tax code. Part of your cell phone, internet, subscriptions. Most business owners use the same phone and internet connection for both work and personal use. You can deduct the business use portion of these services. Just be sure to document it clearly. Also, let's look at software subscription, online services, productivity tools, business-related coaching or education. If it supports your business's operation, development, or marketing, it may qualify. The big idea here is integration. My experience has showed me that the most tax-efficient business owners integrate their business and their personal lives strategically, not haphazardly. They don't cross the line between personal and business, but they do understand where that line is and how to operate right up to it with confidence and clarity, because every qualified business deduction reduces your taxable income. It increases cash flow and keeps more of your hard-earned money where it belongs, and that's in your pocket working for you. Number 4, don't ignore health benefits and HSAs. For many business owners, healthcare is seen as an annoying cost, something you have to deal with when you need it rather than plan for it proactively. But if you're running a business, you have more control over that than you think. How you structure your health coverage can help reduce your tax liability and build long-term wealth through your health strategy. Let's break this down. So let's start with the basics. Health insurance premiums. If you're self-employed, you can typically deduct 100% of your health insurance premiums from your taxable income, whether you're purchasing insurance for yourself, your spouse, your dependents. This deduction isn't taken on the Schedule C. It's an above-the-line deduction on your 1040, which means it lowers your adjusted gross income, and it can reduce your tax bill even if you don't itemize. It's one of the simplest ways to reduce taxes, and it's often underutilized because business owners don't realize they qualify. If you have employees, you can also deduct the cost of their premiums as a business expense, and depending on the size of your team, you might be eligible for small business tax credits under the Affordable Care Act. Now let's talk about HSAs. This is one of the most underused tax tools available. It's the health savings account. It's often misunderstood, but it's one of the only accounts in the U.S. tax code that offers triple tax advantages. Contributions are tax deductible, growth is tax deferred, and withdrawals for qualified medical expenses are tax free. In 2025, you can contribute up to $4,300 for individuals or $8,550 for families. And if you're over 55, you get an extra $1,000. That might not sound like a game changer until you just realize the long-term power of the account. Smart business owners typically treat their HSA like a stealth retirement account. They contribute the max. They invest the funds and they avoid touching it for years, letting the balance grow tax-free for future healthcare expenses in retirement. You can even reimburse yourself later for past medical expenses as long as you have saved the receipts. If you're already maxing out your 401k, your SEP IRA, the HSA is an excellent additional strategy that gives you both flexibility and tax efficiency. But here's a bonus strategy. It's a health reimbursement arrangement, or an HRA. If you own your business and you're looking for a way to reimburse yourself and your family members for health expenses, the HRA might be an option, especially if you're married and your spouse works in the business. Here's how it works. You set up a plan that allows the business to reimburse the employee, your spouse, for out-of-pocket medical expenses. The business takes a deduction and the reimbursement is tax-free to the employee. You're essentially shifting healthcare costs from personal after-tax dollars to pre-tax business dollars. There are rules and documentation requirements, but for certain business owners, this strategy can offer thousands in annual tax savings while helping cover real expenses you're already paying anyway. The point, health costs are unavoidable. But if you're a business owner and you have a unique opportunity to turn those costs into tax deductions, and in some cases, long-term assets, ignoring these strategies can mean leaving money on the table every single year. Using them intentionally can lower your tax bill today, improve your cash flow, and build more resilient retirement tomorrow. Number 5, let's get serious about proactive tax planning. There's a major difference between tax preparation and tax planning. Most business owners don't find out about this until it's too late. Tax preparation is what your CPA or tax software does in the spring. It's historical, it's backwards looking. It'll ask you, what happened last year and how do we report it? But by the time you're sitting down to file, it's too late to change the outcome for this year. The year is over, the opportunities are gone. But proactive tax planning, on the other hand, that asks a much more powerful question. What can we do this year to minimize next year's tax bill, legally and strategically? This is where smart business owners can separate themselves. They just don't react to the tax code. They structure their business, their income, their investments, and their expenses around it within the rules with a clear strategy. What does real tax planning actually involve? It's not just looking over for last-minute deductions in December. It's a coordinated year-round process that includes, number 1, your entity review. Are you using the most tax-efficient structure for your income level? Could you switch to an S-Corp to save thousands in self-employment taxes? Should you create a second entity for a spouse, real estate, or intellectual property? Timing of income and expenses. Should you delay invoicing until next year to reduce this year's income? Should you prepay expenses, upgrade your equipment, or make strategic purchases before year end? The IRS allows cash-based businesses to control taxable income through timing. But if you're not planning ahead, you're giving up that control. Number 3, retirement and benefit planning integration. Are you using the right mix of retirement accounts to maximize your deductions and deferrals? Could layering a defined benefit plan on top of a solo 401k allow you to shelter 6 figures? This is where business income, personal wealth building, and tax efficiency all intersect. Number 4, asset and investment coordination. Have you considered tax loss harvesting or a qualified opportunity zone? Are your passive losses being utilized efficiently? Could you reposition assets to reduce your capital gains exposure in future years? I believe it's not about cheating the system, it's about understanding it. The tax code is there for your benefit, and it is thousands of pages long. Roughly 95% of it is not about what you owe, it's about the incentive and expectations built in for those who know how to use them. Most small business owners are so busy running their business, they don't have time to uncover these strategies themselves, and most CPAs aren't offering them proactively. That's why tax planning isn't about something you do alone or last minute. It's something you build into your financial strategy all year long with someone who understands the full picture, your business, your income, your goals, and your timeline. If you're running a profitable business and don't have a clear tax strategy in place, by mid-year, chances are you're not planning, you're just guessing, and guessing can be expensive. But with the right plan, the right structure, and the right guidance, you can start turning taxes into an opportunity, not just a liability. Being a successful business owner means wearing a lot of different hats. You're the leader, you're an operator, you're the decision maker. But if you're not wearing the tax strategist hat or working with someone who is, you're likely overpaying and underserving your future self. The IRS isn't the enemy. The tax code is complex and it rewards those who understand it or surround themselves with someone who does. There's no glory in working harder than necessary just to send more of your hard-earned income to the government than the law requires. requires. You built your business with intention. It's time your tax strategy reflected that. If you're a business owner earning 6 figures or more and you're tired of wondering if you're doing it the right way, book a call with me using the link in the description below. We'll walk through where your business stands today, what's working and what might be costing you more than it should, and how to build a tax strategy that's ethical, effective, and aligned with your long-term goals. Because saving on taxes isn't about cutting corners, it's about thinking ahead.